Our next guest is bullish on stocks heading into the new year, particularly in emerging markets and Japan, and he has tweaked his top 40 stocks as well. Jeff Palma is global equity strategist at UBS, and he joins us from his trading floor out in Connecticut. Jeff, good morning.
Good morning.
So stocks doing rather well this year, and after a 23% gain last year, you're still bullish. How come?
We are. I mean, I think what's really driven us over the course of the last few months has been a clear improvement in underlying economic conditions. We think that's going to persist into next year, and that should allow PE multiples to continue to rise.
All right. So like you, I mean, but some people say the market is undervalued at this point. But if any of those risks that are out there, and I think about Europe, I think about housing, maybe a double dip there, the labor market's still constrained there, consumer confidence could be whacked. I mean, that could change the valuations quickly and rather dramatically, couldn't it?
For sure. I mean, we will definitely, I think, almost certainly see spikes in volatility along the way and concerns that pop up, whether it's about Europe, whether it's about China or some of the other issues. I think the good news, though, is that the employment situation in the U.S. seems to be improving. And I think as long as that continues to happen, that's going to be the single most important driver.
All right, but it has to improve in order for things to remain upbeat.
I think so. Otherwise, we will come back to this question about double dips. We will then start to question about the sustainability, not only of the equity market rally, but the economic recovery itself.
Talk to me a little bit about Europe, because you guys, I believe you are underweight Europe, or you've gone underweight Europe. We had Scott Meinert on yesterday from Guggenheim Partners, and he said that the subprime meltdown was just the opening act to the broader crisis. He is really worried about Europe. I mean, isn't that a big, big risk to next year's really kind of market environment, to next year's outlook?
Well, I think what's interesting is over the course of the last few months, we've, of course, gone through some of the issues in Ireland and concerns about the periphery, and actually equity markets were able to rally through that. Now, if we get another round of worries in Europe, and in that meaning Spain and Portugal and what that's going to mean on the banks and so forth, I think that will cause a rise in risk aversion and will cause some jitteriness in markets. But I think the question is how it gets dealt with. Do we end up coming up with a comprehensive solution in Europe? And I think if the answer there is yes, equities will respond quite favorably in the end.
If the answer is no, or it takes them a long time, what does it mean then?
Well, then we're going to have serious growth challenges in Europe. There's going to be rising risk aversion. There'll be concerns about the financial system in Europe. And then you run the risk of a broader contagion into other markets that spills into, risk appetite really drying up and moving down. In the end, I'm not sure that that's going to change the underlying growth dynamics in the U.S. So that probably helps as a stabilizer for markets.
Right.
But unquestionably, it would raise volatility.
Let me ask you, we've talked about the U.S., we've talked about Europe. You have increased your allocation to Japan. How come?
We have. I mean, we still think of that as a tactical call. I think that the longer-term structural challenges on Japan are quite big. But we think that the yen is going to begin to weaken up here. It's certainly come off its strongest levels of the year. As that happens, that should help the export sector. And as that happens, it should allow Japan to catch up a little bit. It's really lagged the global recovery over the last couple of years.
Jeff, I want to go back to risks for a moment. The only reason I bring it up, I'm tracking these headlines about a bomb squad in Italy apparently sent to the U.S. Embassy to look at a suspicious package. I mean, this is a story that's crossing, it's developing, just some headlines. I mean, these risks continue to be out there, whether it's terrorism, these suspicious packages, possible bomb threats, and so on and so forth. I mean, how does that play into the market psychology next year? Do we become kind of used to it, or no, that has the potential to rock the trade as well?
Well, I think geopolitics generally is going to be an ongoing risk, and there's no escaping that. We know that political tensions are high in a lot of places. You have issues about packages and those sorts of things. I think there's no way around it, but as long as all of these things are relatively isolated, I think we should regard those as relatively short-term bumps against the longer-term fundamental backdrop. And so I wouldn't regard any of these as game changers, but in some ways we should expect more of the same.
All right, we've got to run. Jeff, thank you so much. Jeff Palma is global equity strategist over at UBS. Jeff, thank you so much. Have a good new year.